Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So I'm going to dive right in, take a look and see what people are sharing, and I'll interject my opinions as we go. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com. That's where we've got a Discord channel there. We talk back and forth throughout the day. I'm on it sparingly throughout the day. We have question and answer sessions on the weekends to answer whatever questions if you want to show up and ask them. And I do midweek updates, sharing what I'm doing in the markets and what I'm purchasing myself. So scrolling down, I am sharing a couple of things, the way that I kind of view the markets, at least partially, and some potential good setups. Crude oil versus other commodities, and I do a lot of ratio analysis looking at an asset versus another asset to see if it's cheap versus history, and if it's breaking any sort of pattern, maybe we are going to get a potential run, uh, especially if you're coming from a low valuation going into a higher valuation. So crude oil versus other commodities, you can see this is silver. So crude oil versus silver. These are future pricing. Consolidation basically in this falling wedge. We've broken out of the falling wedge and we've been consolidating on top of the pattern. And that is generally a bullish formation to go higher. The crude oil could outperform silver in the short term. And I know that sounds weird. Even myself, I kind of think, if we're going into a recession or a slowdown, if there is one, well, why the heck is crude oil sitting on top of its pattern looking like it wants to break to the upside? And that's where the narrative may not meet the data that we're seeing in the market. So we very well could see crude oil outperform silver here. It's possible, and that's what we're looking at. How is the market positioning? Crude oil versus Dow Jones Industrial Average, we have a falling wedge, a three-hump consolidation, a false breakdown, which is a slingshot to the upside, and then we've consolidated again in another falling wedge. That looks, hopefully, like we can break that eventually to the upside. We are coming from extremely low valuations against the Dow Jones Industrial Average. The crude looking pretty good there. Crude versus gold. And I want to look at crude against everything that I could. And I posted four of the things that look pretty good. We had an uptrend here into the peak of 2008. 2008 was your peak where crude oil was the most expensive against gold. We declined in a consolidation here. Hump one, hump two, hump three with a false breakdown. On the opposite end of where we were in 2008, we had the cheapest it's ever been in history, where crude oil went negative, priced negative barrels against gold. So it had the cheapest ratio of crude oil versus gold in 2020. And that's where I said, this is it. I'm going in big. I went in big to a lot of the oil equities in 2020. And we've gone all the way out of this consolidation pattern. It's broken out to the upside of the downtrend. We've consolidated sideways in another pennant formation. There's your pennant. And we are about to break at any point to the upside, it looks like. If we have a slowdown, this would break lower temporarily, and then I think we would go up. Those are two outcomes that are possible still. And then we've got crude oil versus uranium. I know we've got a lot of uranium bulls, as am I. And I just like to see relative valuation. Here's your three-hump consolidation going sideways. We're at a very cheap valuation for crude oil. We could see a big move to the upside where crude oil outperforms uranium for a while. And then everyone else will probably say, well, I thought uranium, is the master commodity. It's going to just rip everything apart. Well, I mean, maybe not. We have to look at everything. And my money goes to where the valuations are the cheapest and where the highest probability of success are. How do you play uranium with equities that don't make any money? It's very speculative in the uranium arena. And all those companies in uranium are very speculative. They don't make any cash flow. Oil companies and energy service companies are flush with cash, guys, and they're cheap. I love those sectors. Absolutely love them. So let's go look at the energy service sectors. So energy service ETF OIH versus other ETF sectors. So OIH is energy service, and XOP is the exploration production companies of oil. We have fallen all the way into a wedge that was squeezed up in late of 2022, early 2023. We've broken to the upside where energy service is starting to outperform, and we could see an outperformance of energy service here. This is very important because we looked at all those charts above, saying that crude oil could outperform. If that does materialize, we could see an outperformance of energy service versus the exploration production companies, which are both highly correlated to the oil price. So I wouldn't go 100% in one or the other. I'd take an approach where I would take maybe an overweighting towards the energy service companies, and maybe not as much of a large of a weighting in the exploration production companies at this exact moment. Doesn't mean I would have done that in history. OIH versus COPX. I know a lot of people are very bullish on copper, but the copper equities, I don't think are going to outperform the energy service companies. Energy service companies are cheap against copper companies, and they look good to outperform. So I would be favorable for OIH. And then OIH versus SILJ. This is more evenly matched. SILJ is one of the other most undervalued sectors or ETFs in the markets. To me, this still looks good for OIH though. So I wouldn't sell OIH and choose SILJ. Maybe I would have a split between the two or some sort of allocation strategy, finding the cheapest sectors and allocating a certain percentage to each of them. These do perform differently in certain market conditions. When the yield curve moves around, SILJ outperforms during one market condition, and then the other market condition, OIH will outperform. So you can use these things to balance a portfolio out as well. And then OIH versus URA, I know we've got a lot of diehard uranium guys. I chose URA because of the history, because it goes all the way back to 2011. That's why I chose this one. And it looks like we've got an outperformance of energy service companies all the way up to about 2016, 2017. Huge underperformance where URA just ripped it. And now we're more equal. We've been trading about sideways with no real gains of URA beating OIH. But OIH could come from a low level and work its way on up again. So I would favor OIH at this level, energy service companies versus uranium ETF. And then looking at Silver Junior, SILJ is one of the cheapest ETFs. So I price SILJ versus silver, and we can see a breakout here. Big, big deal. Another thing to think about is this breaks out during certain market conditions, generally a slowdown. Now, I talk about a slowdown, and sometimes I do look at data that supports a slowdown, like unemployment rate, the yield curve potentially steepening. And I do look at those, and I am a little bit worried for people that can't hold through, the pullbacks. I can hold through pullbacks. But I run the website and people follow me, and it's like, hey, if we do get a slowdown, you got to be mentally prepared for it. But we're also running fiscal deficits of like 7%. And man, that I don't know if we've ever had a recession or a big slowdown with deficit spending that large. I don't know if it's possible because that's essentially stimulus. So tough play here on what's going to play out in the short term. I'm not exactly sure. But we've broken the downtrend here for SILJ. That generally signals that a certain market condition is coming. That occurred in 2016, 17, all the way up to, mainly 2016. We had a big outperformance there. I think something similar could happen again, where the silver junior companies absolutely rip it. And I do have exposure to this. And you guys, if you want energy service company names or silver junior names or something like that, you can obviously join the community and we talk about all of these individual companies that look very good to me, technically, fundamentally, and stuff like that. PSCE, this is a small cap energy fund. It's got holdings that are both in energy service, and some of them are exploration production companies. They're more smaller cap though. And this is versus the NASDAQ Composite Index. The NASDAQ Composite Index is your tech stocks that have been in a big bull market. They've been outperforming a lot of other sectors. So I want to look at this and say, all right, could energy and some of these small caps start to outperform the NASDAQ? And if they do, it's a paradigm regime shift potentially in the markets. So this is what it looks like on a big picture view, which looks very good for PSCE. We had a big outperformance of the NASDAQ from 2014 onward all the way to the bottom of 2020 and a double bottom of later 2020. We had a slingshot upwards, breaking through, and then doing another consolidation here. If we zoom in on the right-hand side here, we can see that we're trying to break through here. And I adjusted it on the dailies, and I went one more. I readjusted it to the peaks here, and we're just underneath that peak. There could be, and I think this is very much the case, a shift of money in the system where NASDAQ may start coming out of favor here and energy, precious metals are going to start to come into favor. When that occurs, we are coming from such low valuation points down here. We have a long runway of valuation to be gained against other financial assets. I think energy service, precious metals, they all look absolutely well positioned here for a big outperformance. And I like that we've consolidated a little bit before what hopefully is a big third wave, what we call an Elliott wave. Here's energy service companies priced in the NASDAQ Composite Index. So this is OIH. You can see we're at like really low valuations compared to the NASDAQ. What this is saying is that energy service companies are literally priced through the floor. You can see last bull market of 2002. I mean, that was up around 0.2, slightly below 0.2. We're at 0.02. We are 1/10 the price in energy service against the NASDAQ than what we were at the beginning of last bull market. That's crazy. We zoom in and we can see that we are starting to break the downtrend. This falling wedge breaking to the upside. And there we are breaking. That's huge, guys. Absolutely huge. We're at a turning point where this thing's inflecting. I'm all in, baby. Coming down to John P. Hustman. So we're going to go into some more information that I didn't post here. So heard on CNBC, you get paid for risk. If you want higher returns, you have to accept higher volatility. The fact is, both return and risk depend on starting valuations. The more extreme the valuations, the lower the expected long-term return, and the deeper the prospective loss. So your risk is very much dependent, and your returns. Your returns and your risk are both dependent on your entry price. And your entry price should be dependent on your valuation. When your valuation is higher, so if you have a higher valuation, you have a lower expected return in the future. If you're coming from very low valuations, your expected returns are higher. That's the whole purpose of me looking at all these different ratios, is to identify things that are one, about to outperform another asset, which means money's flowing into it, and two, we want to come from really low valuation levels. Now, this isn't directly a comparison of valuation. You can do further analysis in the energy service sector to see what the valuations are. And yes, they are stupid cheap. That's what I'll say there. And you can buy them very cheap against free cash flow, which is even better. So here's Ford. He says this is insane. Ford is expecting to lose $5 billion on its electric vehicle business this year alone. In other words, Ford loses $44,000 on every EV they produce. Ford's EV sales were down a whopping 37% last quarter. Disaster is an understatement. Nobody wants at least Ford's electric vehicles. HFI research mapping out where natural gas is going in the near term. It looks like it's continuing heading higher here. And that's what the trend suggests from other years before it. Jesse Felder says it is a misconception that commodities fall in a recession. On average, they rally through one. Whoa, 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 whoa. Time out here. Let's read that one more time. It is a misconception that commodities fall in a recession. On average, they rally through one. So this is commodity rally through a recession. This is the Bloomberg Commodity Index. Mean through recession from 1960. So commodities sell off before recession and then move sideways at the start of a recession and then rally through it. Well, that's what they've got there with the data that they have put together. They rally through the recession but could fall off before it. The long investor, so this is pay attention to what David Tepper did last quarter. So what he did is he added to Baba, PDD, Baidu, and JD. Where he reduced is Amazon, Microsoft, Meta, Nvidia, Google, and AMD. I would do the exact same as this guy. I really do like these companies, and I do think that these are overvalued and look like they're topping pattern-wise. And of course, what does he say? The transfer of capital from US stocks in Wave 5, Wave 5 is the topping of Elliott Wave, to Chinese stocks starting Wave 1 is clear here. He's buying value, and we're at the beginning of a stage 1 or Wave 1 move. I also think that emerging markets are going to outperform because of the currency. I think the dollar will drop eventually, and other currencies are going to go up, which is going to be a very good investment for the movement of emerging market companies. This guy is a very good investor. He's right on top of it. He's doing the same thing that I would do in terms of buying undervalued and selling stuff at the top. Now, is it the ultimate top? I don't know that. I think we are close to one, closer to a top than a bottom in the tech stocks. Says what a wise man does in the beginning, the fool does in the end. So you're buying the top, and what a smart man does is he buys the Wave 1 Chinese stocks here at the beginning. Game of Trades warning recession is closing in, trucking employment is declining, and I know there's a lot of people calling for a recession. They're using a lot of data, and the data does support a potential slowdown. What's difficult is in aggregate, are we going to get a slowdown? And how is that going to impact the markets? It's difficult to say at this time. There's a lot of fiscal spending, and a lot of the times we don't see a recession with the fiscal spending as high as it is. And we've got conflicting data. That's really what it comes up to. Some people think that certain sectors will go through slowdowns and other sectors will go up. And that very well could be the case. Another one from Jesse. He says, despite all the solar panels, all the windmills, the electric vehicles, and the government incentives to go green, the world has never used as much coal as it's burning this year. Coal demand has fallen significantly in rich nations, OECD, and increasingly, any additional reductions would not offset rapid growth in China and India. Here we go with coal. We got Nick here. He says energy remains a sector hated by investors with years of underinvestment in the face of growing global energy demand, a bubble in tech stocks that surpasses anything we've seen, global debt levels at record levels. Something somewhere has to give. And this is hedge fund positioning in energy is the lowest it's been in decades. Yes, great location to look. If you're contrarian and you want to make money, you want to look at energy, in my opinion, right now because no one is over there. Eric Nuttall says, when asked about U.S. shale growth exceeding expectations in 2023, a very wise man told me gravity will take care of itself. The best days of U.S. shale growth are behind us, and its twilight approaches. OPEC Plus, therefore, is increasingly in the driver's seat going forward. Massively important implications here. So this is from Flow, some data here, and this is the lower 48 shale oil wells. And you can see we are starting to decline in flow rates. So this is normalized average oil and months producing, and we are starting to underperform other years for whatever reason. It could be the quality of the reserve. It could be, that's probably what it is, the quality of the reserves. Down here, we've got North American started frac operations by month. So we are actually declining in started frac operations. So not only are we not producing the flow rates per well, we're basically producing less wells. U.S. directed rig count is down, and the lower 48 oil production could be peaking out here at some point. And this all adds up together to paint a picture. So we're drilling less wells that flow less than other wells, and we don't see a turnaround yet. So we would expect oil production to fall at some point, or at least slow down. The yield curve is finally steepening. This is when gold takes off higher, which I completely agree with that. Don't get shaken out, is his opinion. And I would agree with that. When the yield curve starts to uninvert and come on up, that's generally when gold really starts to take off. B of A, the SOM rule says the economy is on the edge of a recession. And then what they say right behind it is, we don't think so. The SOM rule says the economy is on the edge of a recession. We don't think so. That's the 3-month moving average and the unemployment rate minus the 12-month average unemployment rate. And when that comes up and above that zero line, that's generally when a recession occurs. Here's silver, North Star. Silver remains picture perfect and continues to follow the roadmap I issued 5 years ago. We could see a pullback and a retest of the breakout before moving higher. Totally possible. U.S. tech stocks have raced past their earnings similar to the late 1990s. And then the earnings are there, and you can see that the price and earnings are pretty close. And now we've got these alligator jaws that opened up in the year 2000 and where we are today, which could mean a potential slowdown. Maybe. The only difference here is we see the technology investment year over year going down, and then technology investment is up in this case, which may hold off longer. This guy says natural gas is not a bridge to the future. It is the future. UK may need gas-fired power capacity for decarbonized grid. So he's saying it's not a bridge. It is the future. Egon van Greer says, with global debt around 350 trillion and global GDP 100 trillion, the global debt to GDP is 350%. Over 100% debt to GDP is unsustainable and cannot be financed over the long term. And 350% debt to GDP is bankruptcy. But what's next? And that's the entire world. The entire world's bankrupt? Really? Go gold. And that is what I've got for today, guys. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website, guys, if you'd like. And we'll catch you guys this weekend on Sunday, 5 p.m. Mountain Session for the question and answer session. All right, guys. Catch you later. This is Finding Value.